Imagine if you could have bought $1,000 worth of Vanguard's Total Stock Market Index Fund back in May 2000, known as VTSAX, which began trading at exactly $10 per share. Fast forward to today, and that same stake is worth over $40,000, even after adjusting for inflation. That's a 30 times real increase versus our roughly 2% annual inflation rate, which would have left your $1,000 at only around $1,600 in purchasing power if you'd stashed it under a mattress. Today, I'll show you why index funds like VTSAX or its ETF sibling, VTI, Vanguard Total Stock Market ETF, are the simplest, most powerful way to grow wealth. Picking individual stocks can feel like navigating a maze. Fees, taxes, research, and the constant fear of missing the next big winner. Meanwhile, many active funds charge 1% per year and still underperform. In fact, 92% of them failed to beat the S&P 500 over the last decade. No wonder beginners feel paralyzed. What is an index fund? At its core, an index fund is just a basket of all or a representative slice of a market index. The S&P 500 tracks 500 large U.S. companies. VTSAX and VTI go even broader, covering nearly the entire U.S. stock market. When you buy one share of VTI, you actually own tiny fractions of thousands of businesses. Apple, Walmart, Boeing, you name it. That automatic diversification means you never have to guess which stock will win, or fear which one will crash. Here's the shocking part. VTSAX expense ratio is just 0.04%. Compare that to the 1% you'd pay an average mutual fund. That difference costs you over 20% of your returns over 30 years. Lower fees mean more money compounding in your account. Plus, because these funds trade so infrequently, you avoid frequent capital gains taxes, saving you even more versus a high turnover portfolio. Let's compare to gold and Bitcoin. Gold has returned about 4% per year since 2000, barely keeping pace with inflation. Bitcoin, if you were bold enough to buy it at $0.05 in 2010, would have made you rich, but only if you held on, and after surviving multiple 80% crashes. Index funds, by contrast, deliver steady 7 to 8% real returns over decades, with far less drama. So how do you get started? Open your brokerage app, Vanguard, Fidelity, Robinhood. Search for VTI, which stands for Vanguard Total Stock Market ETF, or VTSAX, the Vanguard Total Stock Market Admiral Shares Mutual Fund. Look for an expense ratio under 0.05% and assets over $10 billion for liquidity. Then decide how much to invest. You can start with as little as $50. Rather than one big lump sum, use dollar cost averaging. Invest a fixed amount, say $100 every month. When markets drop, you buy more shares. When they rise, you buy fewer. Over time, this smooths out volatility. In fact, if you dollar cost averaged $100 per month into VTSAX since 2000, you'd have invested $30,000 and be sitting on over $150,000 today. Beginners often chase the latest hot sector or panic sell during downturns. Resist that urge. Index funds are built for the long haul. Buy, hold, and rebalance just once a year. Stay consistent, and the market's upward trend does the heavy lifting. Next time, I'll show you exactly how to rebalance in 5 minutes flat, so make sure you're subscribed. Ready to harness the power of indexing? Drop VTI or VTSAX in the comments below, and let me know when you make your first purchase. Hit that like button, subscribe, and tap the bell, because the easiest path to wealth is one you can automate today.